Evening, all the joinees. Hi, this is Ansu. I welcome you all to the NGEN Markets webinar. We'll be beginning shortly. By the time the others join in, let's have a look at today's webinar topic. So today we would be analyzing and the risk parameters that could be considered for analyzing mutual funds. So the first parameter would be value at risk, which helps you to identify the downside risk of a mutual fund. Next, we would be looking at the capture ratios, which would be the up capture ratio and the down capture ratio. These mainly show how the funds have performed when you compare them with the benchmark, when the benchmark is in a bull run as well as in a bear run. Next, we would be looking at the risk versus return scatter plot. Next, we would be moving down to the drawdown analysis and the recovery analysis, which helps you to understand how quickly a fund has recovered from a loss that has occurred. And finally, we would be having a look at the rolling returns analysis, which shows in the consistency of the fund. In the end, the forum would be open for a Q&A session. You can write down your queries in the chat box or you can unmute yourself. So let us begin. So this is the landing page on NGEN Markets. The Markets tab is the landing page. For our topic related webinar, I move on to the Funds tab, which is the fourth tab. So right here, this is a screener section wherein you can see in list of all the funds that are currently trading in the equity market. Now you can set in certain filter parameters and shorten this list as per your requirements. So for that, I click right here on the filter categories and you can see in a page wherein 4 buckets show up. So these are basically the asset classes. So you can select in the entire bucket as a whole. So for example, I just select in flexi cap funds as a category and all the 39 flexi cap funds would show up in this screener section. So right now, this list consists of the flexi cap funds. Now you can shorten this list by inputting certain filter parameters right here. Maybe you wish to see only those funds which are not younger. Maybe you wish to input an age of 5 years. So I input a minimum age requirement of 5 years. I do not wish to see younger funds. And I input a minimum AUM of, let's say, 2,500. And I click on apply. So as of now, you see the list has gotten shortened and you can see in a total of 16 funds based on the filter parameter that I have input right here. Now there's another filter parameter that right here you see, which is minimum 95% historical VAR. Now what does this stand for? We can have a look at this by loading in a single fund. So for example, I load in Parag Parikh FlexiCap in a new tab. So right here, you can see in historical 95% VAR. So VAR is an abbreviation for value at risk, which shows in the downside risk. What is the percentage of risk for this fund of losing? So this basically means that with a 95% confidence interval, there is a 5% probability that if history were to repeat itself, the fund would go down by a total of 18%, while the benchmark would go down by a total of 24%. So in simple terms, in other words, if I say that if 100 rupees is invested in both the fund and the benchmark simultaneously, the capital erosion for the fund would be 18 rupees, while the capital erosion for the benchmark would be 24 rupees. Now you see here historical VAR as well as implied VAR. The method of calculation remains the same for historical VAR as well as the implied VAR. The only difference is the basis of calculation. In historical VAR, we consider the historical returns for the purpose of calculation, while in implied VAR, we consider the historical volatility for the purpose of calculation. Next, we can have a look at the annual volatility, which is the standard deviation, which highlights what is the risk percentage that was undertaken. So right here, you can see in the risk taken by my fund, which is Parag Parikh, is 12%, while that for the benchmark is 16%. And with this level of risk, what was the return, the cumulative return that was generated by both the fund and the portfolio? So it is clearly visible that my fund generated a better return, which is 572%, while the benchmark generated a lower return, which is 314%. So you can say that from this risk and cumulative return calculation, it is clear that the fund generated a higher level of return with a lower level of risk. And that is what can be seen in the Sharpe ratio, which is the risk adjusted return, which is higher for my fund, which stays at 0.94, while for my benchmark, it is at 0.46%. Next, we come to the up capture ratio as well as the down capture ratio. So as I mentioned, these two ratios mainly show how your fund has performed when the benchmark was in a bull run as well as in a bear run. So for example, the up capture ratio. Here we see how the fund was able to catch up with the benchmark when it was in a bull run, when the benchmark was in a bull run. So right here next to it, you see an eye icon. So I just click on this, and in this, we consider only those months wherein my benchmark has generated a positive return, irrespective of whether my fund has generated a positive or a negative return. So for example, you can see in the month of August 2014, your benchmark generated a positive return of 2.70, while the fund generated a negative return of minus 0.32. While right here, you can see that the month which was considered was October, and post that, the month which was considered was December. So November is missing, mainly because in that specific month, the benchmark generated a negative return. That is why we have not considered that month in calculation of up capture ratio. So once we consider all those months, accumulation is done for the fund as well as the benchmark return. And that is what is written next to the returns column, which is 48% for the fund and 60% for the benchmark. And the method of calculation of up capture ratio is return of the fund divided by return of the benchmark. And you can see a higher is the up capture ratio, better is the performance of the fund in comparison to that of the benchmark. And total opposite is the down capture ratio, wherein we see how resilient the fund was when the benchmark was in a bear run. So I see a eye icon right here. I just click on this. And here you see we consider only those months wherein my benchmark has generated a negative return, irrespective of whether my fund has generated a positive or a negative return. So right here in the month of December 2014, my benchmark generated a negative return of minus 2.02, while my fund generated a positive return of 4.34. And once we consider all these months, accumulation is done, and that is what has been written, minus 16% for the fund and minus 33% for the benchmark. And the formula for calculation of down capture ratio remains the same. The return of the fund is divided with the return of the benchmark. And you can say lower is the down capture ratio, better is the resilience of the fund when the benchmark is in a bear run. Now, these tables that we had seen on a single fund analysis can also be viewed on a portfolio level as well. So right here, you see the minimum 95% historical VAR column. So I input a data. Yes. So I input the data of, let's say, minus 25%, and I click on apply. Now, in order to see if this has been correctly input, I just go here wherein you can see preset column views. There is a drop down. I just click on this and I view the risk columns. So right here, you can see the VAR H columns. The data which is visible is less than minus 25%, and that is what we had put in the filter parameter. Now, we can compare the performance of these funds and view their risk and return parameters. So for that, I click on this add top 50 to compare. And the funds move to the compare section right here below the fund section. So in this section, since these are flexi cap fund, I can add in a flexi cap index for it. That in as a row item right here. And next we move on to the risk versus return scatter plot. So this is a risk versus return scatter plot, wherein on the x-axis, you can see in annualized risk, which is the standard deviation, while on the y-axis, you can see in the annualized return. And the scatter plot is divided into 4 quadrants: low risk, high return, low risk, low return, high risk, low return, and high risk, high return. So for example, if we view this for a duration of 5 years, maybe starting from September maybe starting from February, just a minute, February 1st, 2019 to 2024, and I click on go. So right here, it is clearly visible that for PGIM and Kotak FlexiCap, the risk percentage is almost the same, while the return that has been generated by PGIM is higher in comparison to that of Kotak. PGIM generated a 19% return, while Kotak generated a 16% return. Now, if we view at Parag Parikh FlexiCap, this can be seen that it is a fund that has taken the lowest level of risk while it has generated the highest level of return. While the total opposite you can see is for Motilal Oswal, which has taken up a higher level of risk, but it has generated the least amount of return. Now, if we take this scenario, maybe for a 1 year duration, maybe 2023 1st Feb, and we see how the funds have performed. So right here, you can see what Motilal Oswal was in a 5 year duration, it was at a high risk, low return range. And in the last 1 year, you can see that it has maintained the same level of risk, which is high risk. But at the same time, it has generated a high return as well. But whereas for Parag Parikh FlexiCap, it had generated a low level of risk. It has maintained that and it has reduced the return percentage. While the PGIM as well as the Kotak, initially for the 5 year duration, PGIM was generating a better return. While in a 1 year duration, you can see that the returns for PGIM has fallen when you compare it to that of a Kotak FlexiCap. So risk versus return scatter plot helps you to determine that if two or more funds have similar level of risk, what is the return generation capacity of these funds in different scenarios. Next, we move on to the drawdowns tab. So this tab mainly shows in the strength of the fund to recover from a loss that has occurred. So right here, you can see in 5 worst drawdowns have been highlighted with the topmost worst drawdowns being shown in this first column. You can see in terms of size, what was the worst drawdowns for the funds. And this can be viewed in detail as well. So there is a history I can write here. I just click on this. So as of now, I have taken in Axis FlexiCap. So the highest loss that was experienced by this fund was a total of 30%. And this started on 12th February 2020, wherein the start price was 13.38 rupees. So this fund had a price of 13.38 and it started falling and it reached a price of 9.36. And that happened on 23rd March 2020. So maybe you can see there was a loss for a period of 1 month. And post the date of 23rd March 2020, it took a total of 165 days for this fund to recover. And by recover, I mean it took 165 days for this fund to cross this start price of 13.38. Only then we can say that the fund has completely recovered from its loss. And this recovery happened on 9th November 2020. And that you can see right here on this line graph as well. In the month of November, you can see that it has crossed the specific start price that has been mentioned. And in the line graph, the white region shows in an up movement, while the gray region shows in a down movement. And you can see it by zooming the screen. You can see in detail how the movements for the fund has been occurred. Now, if I sort these funds based on their recovery, you can see that there are 4 funds that have recovered sooner in comparison to the Nifty 500, which is the index. In terms of their worst drawdowns, the best recovery goes to Parag Parikh, which is it took just 75 days to bounce back from its worst drawdown. Well, there are 4 other funds which performed better in terms of their recovery when you compare it to that of the index recovery. Next, we move on to the rolling returns tab. So this tab mainly shows in how consistent your fund has performed. So here we can see in a rolling window, which is the holding period of 260 days. So 260 days is equivalent to 1 year. If you wish to see this rolling return for maybe a duration of 2 years, you multiply 2 into 260. You just multiply the number of years into 260 and you can see the rolling returns for that specific window. So right here, the first column you see is the average column. So this column is the average of all the data points that you see on this line graph. An average of these data points has been mentioned right here in this average column. So clearly there are two funds that have performed better in generation of a rolling return in a 260-day rolling window when you compare it to the benchmark. Parag Parikh and PGIM has given a better average when you compare it to Nifty 500. Next, we come to the positive percentage. This column helps you to see the number of times a fund has generated a positive return, considering that there are only two quadrants, positive as well as negative. So right here, you can see Kotak, 87% of time, Kotak has generated a positive return. Now we were viewing this for a rolling window of 260 days. Now it is said that the more you invest in mutual funds, the duration, the more longer you invest in a mutual fund, the positive or the higher would be the return. So for example, if I change this rolling window to a 3 years, which is 780-day rolling window, and I click on run. So you can see clearly that the lowest return that was generated by the funds are still in the positive quadrant. They lie in the positive quadrant. And that is the reason the positive percentage column shows in 100%. While when we were viewing it for a 260-day rolling window, the lowest return showed in a negative percentage as well. Now, these rolling returns as well as drawdown tab can also be viewed on a single fund basis as well as on a portfolio level. So I load in a single fund, which is a Parag Parikh Flexi Cap, and I go to the drawdowns tab. So the drawdowns tab right here for a single fund, you will be able to see in the top 10 drawdowns. The meaning exactly remains the same. The days to recover highlights the total number of days taken by this fund to recover from this loss. By that, I mean the total number of days taken to cross this start price. And you can see that on the line graph as well. And next is the rolling returns tab. Right here, you will be able to see a rolling window for a three time periods. So right here, again, you can edit these rolling windows, just multiply the number of years into 260. So here it is clearly visible that as the rolling window kept on increasing, the average return that was generated by this fund increased. In 260-day rolling window, it was a 17% average, while when the rolling returns was for a duration of 3 years, it increased to 51%, the average percentage. Now, this data can also be seen on a line graph. Now, if you wish to see the rolling return for just 520 days on the line graph, I deselect this 260 as well as 780. So you can see in the line graph how the 520-day rolling return window is performing. Now, as I mentioned that this can also be seen on a portfolio level, I go back to the NGEN Markets platform. In the portfolio section, I load in a portfolio. And I change in the start date to, let's say, 5 years ago. And the rolling returns tab right here. Now, this information is seen on a portfolio level. What we saw initially was on a fund level. Now, this detail lies on a portfolio level. You can see that as the rolling window kept on increasing, the lowest return that was generated by this portfolio was a positive 47% in a 780-day rolling window, while in a 260-day rolling window, it was a negative 22%. Now here you have an option to create in returns distribution for the specific rolling window. Right here, there is an option. Once you click on this drop down, you see 260, 520 and 780. This is exactly what is there right here in this three columns. Now it is at 260 and you can create in return intervals and check the probability of this portfolio to generate returns in that specific return interval. Now, for example, if your client wishes to see that if his portfolio could generate a return range between 10% to, let's say, 40%, I input this data and I click outside. So right here next to the data or the return interval that I had input, it shows 48%. So this basically means that there is a 48% probability for this portfolio to generate returns between 10% to 40%. Now you can create in return ranges as per your requirement or as per your client's requirement. You can create in 5 intervals right here. And as I mentioned, the drawdowns remains the same. Right here, the price that you see on a portfolio level is the weighted average price of your portfolio as a whole. So weighted average basically means the NAV of these funds are multiplied by the weightage, individual weightage of these funds in the portfolio. And that is how we have reached at this portfolio price in terms of determining the drawdowns. And here as well, you can see in the top 10 drawdowns. And the corrugation is the white region shows an up movement while the gray region shows in a down movement. So that is it for the topic related webinar. If there is any query, you can write down in the chat box or you can unmute yourself.
Um, okay, there's a question in the chat box which says, can you explain information ratio? Okay, so typically information ratio is an indicator whether the portfolio has generated a alpha, that is the excess positive excess return over the benchmark, and whether it has done that by actually maintaining what is the tracking error of that particular fund or for that matter portfolio. So first, let us check it on a actively managed fund. For an example, a Parag Parikh, right? So we go to the Parag Parikh FlexiCap tab and we go to fund performance. Right here, you see information ratio. Now, this is for the period of 2013 to 2024. Let's simply change this to a 5-year period for simplicity's sake. So, we have done a 5-year analysis, so 2019 to 2024 typically. And we see that in this 5-year period, the fund has managed to generate an excess return over the benchmark, right? So, it's a positive alpha. And therefore, even without looking at the information ratio, you'll be able to tell that the information ratio is going to be positive. Why is that so? Because information ratio is nothing but a ratio, right? A numerator upon denominator of annual excess divided by the tracking error. Now, what does tracking error mean? Tracking error typically tells you how much deviating was the fund's returns as compared to that of the benchmark, relevant benchmark. And therefore, tracking error as a ratio is always a relative indicator, relative to a benchmark. Tracking error as such can only be calculated when the fund's performance is being compared to a benchmark. Okay, so for an example, in this case, it's an actively managed fund. Therefore, its objective as a fund manager's objective is not going to be piggybacking the benchmark's return. Therefore, there is going to be a higher tracking error because he is trying to do something that is different than the benchmark itself. And therefore, the tracking error is higher. So when you calculate information ratio, there's nothing but a numerator upon denominator of annual excess simple divided by the tracking error. Typically, if you are looking at a passively managed fund, right? For an example, let me quickly load in a index fund. So let's just try and load it here. Okay, so let me load in a Motilal Oswal Nifty 500 index fund. When I do that, I click on it and it gets open in a new tab. Typically, the benchmark is same, right? Parag Parikh also follows a Nifty 500 as a benchmark. Motilal Oswal is also going to do that because simply it is a Nifty 500 index fund, right? Again, the period under consideration, let's keep it to a 5-year period. It's a young one once again. Okay, doesn't matter. This is a 5-year analysis, September 2019 onwards. And let's change the benchmark to a Nifty 500. Okay, typically we will see the tracking error for this particular fund is going to be very, very low. Why? Because it's an index fund. The motive or the objective of this fund is to piggyback the benchmark, which is its relevant benchmark, Nifty 500. It is going to follow the same strategy as Nifty 500. And therefore, the tracking error you will see is very, very low, 1.22%. Versus Parag Parikh's tracking error was at 10.59% because it's trying to do something else or something different than the benchmark itself, right? So this is how the components of information ratio are: tracking error and annual excess, that's alpha over the benchmark, and simple excess divided by the tracking error gives you information ratio. Okay, there's another question in the chat box which says, can you please also show how to upload a portfolio for analysis? Sure. So on the platform, we have 3 portfolio onboarding options. Let me come to them one by one. Typically, for all of your existing clients, we have in the client section RTA connection, wherein we onboard your CAMS and CARVI mailback files. For CAMS, we onboard WBR4s, and for CARVI, MFSG 203, wherein we take your latest holdings. Okay, and your existing ARN clients, even if it's multiple ARN, can be onboarded onto the platform like this. Our RTA team will get in touch with you once the setup is done. Within the next 2 days, your data should be integrated, right? And then you can simply click on the name of the name of the portfolio of the client, and the portfolio analytics can be run on the fly. This is for all of your existing clients. Now for prospectives, what we have is 3 other options. The first is the statement analyzer. This option you can see at the top, right? Launch tools is a static tool that stays anywhere you are on the platform. You simply click on statement analyzer, and this platform lets you onboard NSDL, CDSL, and CAMS ECAS files of your prospectives, right? So these are PDF statements, generally password protected. You have to simply choose a file, put in the file password, and click on check file. This is how the file will get processed and get saved onto the right hand side. Once this file is onboarded onto the platform, you go back to NGEN Markets, either in the clients or the portfolios section, you go to manual data and choose add client from statement analyzer. Here you will see a list of all the ECAS statements that you have already onboarded, right? Already saved onto the platform. You simply click on add button, meaning, click on that, press a new add all the holdings, and then the file of the portfolio of the client will get loaded like this. Right? So this is how you can onboard using ECAS statements. The second portfolio onboarding option for a prospective is to add his holdings through an Excel file, right? So for that, we have to go to the portfolios tab. The moment you go to the portfolio section, you will see add a new portfolio icon. Click on that, and you'll be given an option to copy and paste ISIN data from an Excel sheet, right? So all you need is 2 columns. One should be the ISIN number, and the second column could be either of percentage or amount or units respective to those ISINs, right? So for an example, I'm just taking a units example, wherein in the first column I have ISIN numbers, and the adjacent column has the units or the shares of respective ISINs. Then I ask the system to read this as whatever example I've taken. So these are units or shares. So I'll ask system to read the holdings as units or shares, and then I click on validate input. The moment I do that, the names of the funds respective to those ISINs are going to get captured like this, and percentage, the units are going to get converted into percentage terms. Once that is done, you either enter the name of the portfolio, or you simply click on run. That's how the portfolio analytics can be run. So that's the second way of onboarding a prospective client. The third and the last way is, of course, keying in the data manually, right? Let's say for a prospective, you do not have a ECAS. Let's say you also do not have in an Excel sheet, right, the holdings, but you simply know okay, these are the 4 funds that he has, right? So you typically simply go to the client section, go to the manual data tab, click on add client manually, put in the name of the client. So let's say PSJ, I click on add client, and the holdings can be unloaded like this. So let's say he has a Axis midcap. Choosing the name of the fund, the units can be input. So you can input either units or current value. The moment you input one field, the other is going to get automatically populated basis the latest available NAV date. So for an example, let's say this particular client has 5,000 units of access mid cap. I put in units, automatically it will calculate the current value basis the latest NAV. First Feb NAV was 85.92. It is automatically going to calculate the current value like that. Okay, so either of the two is required to create a portfolio. So these were the multiple portfolio onboarding options onto the platform.
Any other questions, please let us know. Okay, if there's nothing else, we can close for today.
Yes. Thank you all for joining in for today's webinar. You can visit our YouTube page, wherein you can see in a dedicated playlist for all the webinars that have been conducted. A total of 98 videos have been uploaded, and today's video would also get uploaded. Thank you all for joining in. I hope to meet you again next week with a new topic. Thank you.
Ma'am, I'm sorry to interrupt. I just had one observation, ma'am. Can I let you know?
Yes, please go ahead.
Ma'am, okay. So can you just compare two portfolios, ma'am?
Yeah, one second. I've taken in two portfolios. Let's consider a start date, let's say 2020 onwards. Yes.
Right, ma'am. So when we see when we compare the two portfolios, existing versus the model portfolio,
Yes.
all these digits, like they are better. Like the first existing one, 0.04 and minus 0.10, right? So there's a difference of minus 14.
Yes.
Correct. So when we moved on to the Sharpe ratio, ma'am.
Yes.
So the Sharpe ratio of the second portfolio is better, correct?
Correct.
So in that case, it is showing plus 0.05, which I think it's taking a mathematical figure. Sharpe, the higher the Sharpe, better it is, right?
Yeah, that's right.
Yeah. So I just had, like, we were just discussing the other day. If you could make this, I think there's this change that if you can make, I think it's mathematical, but I think it works the other way around.
Okay, so look, on the right hand side, we have a model portfolio, right?
Correct.
And on the left hand side, it's an existing portfolio. So, for an example, in this case, the Sharpe ratio of the existing portfolio. Now, this existing portfolio is a prospective's existing portfolio. So, typically, what I have loaded is, in such a manner that the model is performing better than the existing, right?
Okay.
So,
Okay.
therefore, the Sharpe ratio of the existing is a 0.96, which is lower than my model portfolio. So therefore, it is telling me that your model portfolio gives you an excess Sharpe ratio of 0.05.
Okay, okay. It's the other way around. Okay.
Yeah. Always portfolio 2 versus the portfolio 1, right? It is always like that. So basically, if you always have to load the model portfolio or a better portfolio on the right hand side, always.
Okay, ma'am. Okay. Then
Right?
sorry.
You can even see this right here. If you hover on this, I button beside this annual return differential, or for that matter, even Sharpe ratio differential, you will see this. This is the difference of the Sharpe ratio of the second versus the first.
Okay, ma'am.
Yeah.
Yes. Thank you.
Okay. Thank you again for joining in. Have a great weekend. Thank you.